Hi, good afternoon, everyone. My name is Rhonda McGill, and I am the Senior Director of the Client Success Team here at PerformLine. Today, we wanted to get together with some of our friends to talk about minimizing UDAAP compliance risk. And we're going to talk to you probably for the next hour, maybe a little bit over, because I think this is going to be a really great conversation. But we're going to start talking in a few minutes. But prior to that, I'm going to allow our guests to introduce themselves. And because of the length of this particular session, we probably will not have time to take questions, but we will definitely encourage you to put your questions in the chat, and we will definitely take the time to get those answered. But so that we can go ahead and get started, I would love to introduce my three guests that are here with me today. I'm going to turn it over to Pia Thompson to get started and give her introduction of herself. Pia.
Sure. My name is Pia Thompson. I've spent a handful of decades in this space, 19 years in private practice with some big law, and the last 10 as general counsel, mostly in the Fintech financial services space. So quite a bit of interaction with the CFPB and all the other alphabet agencies. And I'm very excited to be here to talk about this topic. Right now, I am the founder and fractional GC of lawesomeGC, awesome with an L.
Awesome with an L.
I am the exact same thing as a full-time GC, exactly the same, but I am part-time and work for more than one company at a time. So I'm super happy to be here.
That's awesome. And our next guest is James Kim, and I'll turn it over to James and to introduce himself.
Thanks, Rhonda. Hi, everybody. My name is James Kim. I'm a partner at Troutman Pepper. I'm a member of the Consumer Financial Services Group. I'm also the head of the Fintech practice group. As my kind of titles would suggest, I'm a regulatory attorney focusing on consumer financial services with a kind of a particular focus on all things fintech. And I think relevant for this discussion, in addition to, kind of my years in private practice counseling companies, I did work at the CFPB in the office enforcement back from 2012 through 2014. So I've been at the CFPB, and I think we all know, and we'll discuss how UDAAP is really a powerful tool for the regulator because it's whatever they want it to be. So I think having that kind of insider's perspective can be helpful.
Thank you so much. And last but not least, we have Brian Serafin, who's here. And Brian, go ahead and give an introduction of yourself.
Hi, my name is Brian Serafin. I'm a partner at the law firm Weiner, Brodsky in Washington, D.C. My focus, it's all in the financial services sector. It's about 50% litigation and about 50% regulatory compliance advice. So we tend to focus on the mortgage industry, settlement services, banking. So I'm very happy to be here. Thank you for having me.
And thank you all again for joining us today. I think this is an important topic that really has piqued interest. And during this campaign for UDAAP, we've seen quite a few of our folks have expressed a lot of interest in the content that we've been putting out. So with that said, just to give some of that background as we're talking about UDAAP, we know that UDAAP has evolved throughout the years, and most notably in the 2007, 2008-ish crisis with financial sector, Congress started issuing that authority to the states and banking agencies, and then the creation of CFPB in 2010. The financial services industry has changed so much throughout the years, and it's continuously evolving, and oftentimes it's going at a faster clip than what our regulators are even able to keep up with. And so but it's still incumbent on the businesses to, stay on top of these evolving regulations. What do you recommend companies do so that they can stay up to date with UDAAP regulations and the many emerging issues and trends within it? I can turn it over to whomever would like to jump in and start on that one.
Well, as in-house, just super quick, I think it's important to have your counsel kind of selected so that you're not always reacting. And so those are an extension of your in-house legal department. And so they'll notify you, they will know about your business. In addition to, services and outside vendors that aren't law firms, but are heavily embedded in the space, because it's very hard in-house to be up to date on all of those things, even with the compliance department, even with regulatory lawyers. We have company things that we're focused on.
Brian, you were going to say something?
Yeah, no, I was just gonna say, one of those things actually that I found to be really helpful, the CFPB publishes something, it's about 2 or 3 times a year. They're called supervisory highlights. Basically, they're reports of violations that the CFPB has been discovering during their examinations. Obviously, exams are confidential, so it's all on a no-name basis. But I found it's a pretty helpful source to identify either A, issues that they've suddenly seen a lot of people committing, or B, it's kind of a place where they start to sort of put out the first notions when they have a new legal theory. Those sort of identified in some of these highlights. And I've actually found this to be really useful just as a source of is a place where they kind of telegraph some of what they're intending to do going forward. And the CFP, they publish a lot of material. They guidance statements. They have blog posts and articles on their website, which are a little more consumer oriented. But again, these publications, they tend to be a pretty good way to find out what's coming down the pipe.
Brian, thank you for pointing that out, because one of the things we do is we summarize the quarterly enforcement actions for CFPB that impact our business. And for example, in California, the DFPI or other states that have an active state bureau, so that the board is being updated with respect to our industry. So Brian, that was a great reminder that somebody in the compliance department, that is their gig for the board materials each quarter.
Absolutely. It's so important. And I think so often boards are kind of the last to know. So that's a great call out about the importance and the duty of the board.
Yeah, just to add on that, and I agree with both Pia and Brian, so I want to just kind of add to what they're saying, build on it. I agree with Brian 100% that the CFPB's quarterly supervisory highlights are often a precursor to kind of more aggressive legal theories that they will eventually assert or are asserting non-publicly in an enforcement action, and you don't see the output until a year later in a public consent order. So that's why you got to review the supervisory highlights in tandem with the enforcement orders, because I think that gives you a better, kind of more complete picture. And then to kind of piggyback on one of Pia's comments, UDAAPs present a lot of challenges, but it's not for lack of information, because there are a lot of bulletins and guidance and consent orders, and it's almost overwhelming, right, if you're in-house. So I think one of the ways that outside counsel can help you is not only just staying abreast, because a lot of people can kind of stay abreast of these developments because they're mostly public, not always, but it's understanding how a consent order supervisory highlight, which the fact pattern may be kind of vague or not applicable to you, how that will translate to your business model or your product. So having that knowledge, either in-house or outside counsel, of what you do, of your particular issues and product offerings, and kind of, I think transferring the kind of the data sources that can be overwhelming, and kind of sifting through it to say, this is what's relevant, and specifically, how is it relevant to you or to us?
Makes a lot of sense. So recently, the CFPB issued a policy statement on abusiveness to address the changing market. And in a recent speech, I cannot remember where it was at, but I'm going to kind of paraphrase what Director Chopra had said, because it really was really explanatory background where he said the abuse of prohibition is focused on a company's conduct that obstruct people's ability to digest information, whereas deceptions are more concerned with words and abusive actions. So can each of you share some of your thoughts about the policy statement, and what do you believe are some of the important takeaways that we should be aware of, especially I'm looking at like AI and, how that's starting to emerge. As these things continue to emerge, what are some of the things that you can think of that people should be aware of as it applies to that abusiveness policy statement? Let's start with Brian.
Yeah, sure. No, I think the abusive standard, it's interesting because, obviously the statute, it covers unfair, deceptive, or abusive acts or practices. And the unfair or deceptive components are fairly well known. I think those two parts, unfair, deceptive, came from the Federal Trade Commission Act from something like 1938. So those have been around a long time. They've been deeply interpreted by courts. Whereas this abusive prong that kind of came into the CFPB statute is somewhat newer. And so there has been a lot of effort to try and figure out what is abusive that would not otherwise also be unfair or deceptive. Basically, what does abusive bring to the game that wasn't already there? So that was why the new policy statement that they issued was pretty interesting. Again, it seems like their focus, they sort of put it under two components. Basically, they didn't want, I guess, they really don't want people to be taking advantage or unreasonable advantage of consumers.
Yes.
Just based on sort of circumstances that might arise around the transaction. It might not even be something that the lender, the financial service provider set up, but just something that'll prevent the consumer from either understanding the product that's before them, or else also
Brian, can you give some kind of concrete example of that? Because one of the frustrations I think that I find is, it's also nebulous, and it's a way for them to back in, anything to UDAAP. And so so I wasn't so convinced that this policy statement helped, really. So if you could give any, examples of how you think it would help a company dealing with consumers, that would be great.
Sure. So again, one of the big things, it looks like, they're very skeptical of disclosures and fine print. And one of the things I've noticed is actually they've taken a big interest in websites. So you might have, someone signing up for a service on a website, for example. The disclosure might be presented, but if you have to click through a couple extra buttons to get there, or if it's, somewhere on the page where it's just a little harder to see than the buttons you click to go through the sign up process, that's one of those kinds of things that they seem to be focused on.
Okay, and on that, I want to say something very specific on that. So this is something that I have to explain to my companies on a regular basis, and I have had a state attorney's, I've had more than one state attorneys general say to my face, we understand that there isn't a consumer on the planet who will read any of your stuff. We are the ones who will read it and we will judge it. And so I get a lot from my business folks who are like, we're not putting in 3 extra click buttons and nobody reads it, right? Like I know when my iPhone is updated, like whatever I'm agreeing to could be the entire text of Mein Kampf, right? Agree. I've never read any of them. And so I think that is something we have to highlight is let's stop with the charade that we are putting this together for consumers. We are putting it together for regulators because it's what they want to see. Because we actually don't want people buying our products who don't understand what they're getting. Like that's actually not good for business, to have people confused. But what's actually in the words you have to go over and over it for how the regulators are going to read it.
Yeah.
Is what I find, and especially when they'll say that to your face, that we don't actually care if any consumer was ever confused. Like that, they actually, you know, they don't need that.
Right. And I think when you think about like, even like the most recent thing around the Legion, you know, and, you know, who's paying the most to get their name in the top 10 or whatever the list is. I think that's another perfect example of where they are going with this type of a thing. Brian or James, would you want to?
Yeah, just to weigh in a little bit. Yeah, these are some great observations. I agree with Pia that you're doing this for the benefit of the regulator, not the consumer. And I'd say, what else would I add to that about the abusiveness policy? It used to be that if you disclose things well and you had proper kind of process, right? You know, clear flow, clear disclosures, you know, people get to click and see things, that was adequate. I think the abusiveness and the policy statement, and also kind of their whole application of unfairness, really is about outcomes, right? So the process, the flows, the disclosures can be great, but if they just don't like the outcomes, either at an individual transaction level or at an aggregate level, they're going to just assert unfair and abusive. So so the CFPB, sadly, is a result-oriented agency. You know, people talk about process. They're not a process-driven, right? Process is you have public, you know, notice and comment. You have a fair, transparent process. People know, companies know the rules of the road. The CFPB kind of, you know, they have their idea of what their outcome is, and then they play a little bit of gotcha with you, right? So, and then, so what does that mean for companies? So one of the ways I try to give practical advice is really what the CFPB and others want is almost a fiduciary duty. And my colleagues joke with me and they say, James, strike almost. They want a fiduciary duty.
Fiduciary duty, yes.
And so that's the reason why I like using that concept. You'll never see that word anywhere in CFPB literature, but I like to use it as a good practical kind of way of explaining it to companies, because people understand fiduciary duty, product suitability in other fields like security, so they can transfer it, right?
Yeah, I just wanted to say, like, for the audience, if you could kind of really break that down, like, what do you mean when you say fiduciary duty? Like, in our world, what would that look like?
I mean, that means you have to not just be honest and transparent with the consumer, you have to look out and protect their interests, right? I mean, you're taking it to another, they are your fiduciary, you owe them a fiduciary duty, right? That's the outcome. Like, you have to give the consumer a good, fair outcome. It's not enough to just say caveat emptor, I disclose, and if you do whatever you do, that's on you, not on me. That's not good enough. That's fiduciary duty. And the one other thing I'd say about the policy statement, I'd love to get people's reaction to it, is it's, again, not in the policy statement, but Director Chopra's kind of testimony, I think it was testimony, or it might have been his press conference announcing the policy. I think he let the cat out of the bag a little bit. To Brian's point, there's a lot of precedent and guidance around unfair and deceptive. And when Chopra was at the FTC, he was often critical of the FTC and what they did and didn't do. And so what Director Chopra said in his, I think it was testimony, but it was public remarks, is he likes abusive, I'm paraphrasing, because it's not bound by the precedent that he doesn't like about unfair and deceptive. So he has a clean slate to just do whatever he wants, and all the adverse guidance and precedent and cases on UDAAP with 1A, like irrelevant to him, like no barrier.
Yeah.
And I think particularly again in the financial service industry, this can kind of become an issue because, for example, if a consumer is working with a mortgage officer or a bank consultant about which mortgage should you get or which account should you open, you know, the mortgage officer, the bank consultant, they kind of have an interest in making the sale, which oftentimes will be the product that's best suited for the customer, but maybe sometimes there can be some differences of opinion of what's the best product.
Absolutely.
And again, I guess the CP really doesn't want customers to get the impression you're solely focused on doing, picking the product that's the exact perfect one for them.
For sure. Now that's
Brian,
They don't want the customer to think that.
right, and Rhonda, I want to go to one of the things you said in the intro about, so much of this obviously came out of 2008 and the mortgage crisis and the financial crisis. And Brian, you just mentioned mortgage officers. Well, one of the things that I have found over the last 15 years is the agencies and the regulators don't seem to understand the difference between a secured and unsecured product. And so I think a bunch of these concepts, I'm not saying they're completely irrelevant, but ability to repay when it is not tied to your home, when it is not tied to all these other things, is that so relevant? Or is that perhaps an infantilizing of the consumer who needs the loan to make their own decisions? They need this lump sum. They can make their own decisions about what they're going to pay back and what their choices they're going to make from their monthly budget, right? And so they're being kept from getting this lump sum because of a tool that wasn't really meant for that product. And so, James and Brian, I'd love to kind of get your feedback on that, because I've had some difficult times with the Department of Justice, with all sorts of agencies, where no matter how many times I explain it's an unsecured product, they don't get it, and they don't care.
So one of the things that's sort of interesting, again, this is with the CFPB and with some of this consumer protection generally, in a lot of areas of law, the law kind of asks, what would the reasonable person do? The reasonable person standard. But when you get into consumer protection, particularly, for example, in dealing with the CFP, they're more focused on what would be, quote, least sophisticated consumer. So again, they're kind of sort of bending over backwards to kind of make all inferences in favor of the consumer might be one way to look at it. So again, part of it is, what are consumers going to understand? Basically, in some ways, it almost has to be spoon fed to them, or how do you highlight what are the most important parts?
Yeah.
So you're not, overloading them with a hose full of words that not all of them are going to get through. I think that's important. And again, as far as your point of the unsecured loans, again, I think that goes to making them understand what are the consequences if you, for example, don't pay back what you owe.
Yeah.
Making sure they understand that.
Yeah, I agree. Just taking my shot at Pia's question, I agree. It's very paternalistic. I think sometimes the government folks cross the line, and in the name of consumer protection, they're really picking winners and losers in the marketplace. Just some kind of contextual data points, like when Elizabeth Warren over the years talks about the post office offering loans, and banks make too much money. I mean, all of that indicates, like in her mind, and people who think like her, that it really, banking should be just a utility that's a kind of a low profit, widely accessible, kind of a vanilla product for everybody. And the problem with that is you lose innovation, you lose competition. So as a fintech focused practitioner, one of my common challenges is explaining, educating, defending like a kind of a novel product to a regulator, because they're so robotic and rigid in their thinking. If it doesn't fit neatly in a regulated box, they're immediately very skeptical of it, and they think it's harmful, and they don't realize that it's often a market-driven positive alternative to existing products, or an existing problem or gap in the marketplace.
Absolutely.
Well, and on that topic, to take it out to some concrete examples. So I have two things on this, having loans available at libraries or post office. So I was speaking with someone from the CFPB, and I had a high interest loan product, and this guy at the CFPB said, well, I don't understand why these people aren't going to banks. And so I said, I agree with you, and I don't know why they don't have private bankers too, because it's so nice. Like, I've never had to call a toll-free number. Like, I don't understand, why don't they do that?
Yeah.
Right? And it was just so obnoxious on his part, right? We're talking about people who don't have every option. And then here's the second thing, and it goes really directly to this post office idea. So I've been in the subprime space a lot and in the prime space, but in the subprime space, what are the states doing? They are putting in interest rate caps, right, of 36%. Well, that doesn't mean subprime people get 36% loans. It means they don't get any loans. And so if the government has an issue with very high percentage rates that have to exist for two reasons, right? They exist because of defaults and they exist because of cost of capital, right? And who has the least cost of capital? National banks, right? Back in the day, 10 years ago, their cost of capital was 0, right? And they still won't make these loans. So then you go to the fintechs, who sometimes have 12%, 14% cost of capital. Then they have big default rates. And so to be able to offer the product, the math is the math, and you end up with these high rates. And so because subprime lenders are demonized, they decide we're putting in a cap. That'll be the end of this. Well, you know what? If you want to put subprime lenders out of business and not have 50, 60, 90% interest loans, go ahead, give loans at the post office for 30%. And maybe it is a public good that as taxpayers, we subsidize the defaults, right? That's a whole philosophical discussion as to what we should do as a society.
Yeah.
But let's have that discussion. But instead, they just ban it. And so, James, I think that really goes also to your point, where stop talking about it. If you're going to do it, do it. But instead, what you're doing is you're taking this huge group of the American population and saying you don't get credit.
Yeah, thank you for that. That was a great, great discussion. I'm going to move us on into talking a little bit about some enforcement trends and some recent happenings. There's been many enforcement actions from states and banking and federal regulators. Without calling anyone out in particular by name, could you summarize at a high level some recent enforcement actions that you might be aware of and some of your thoughts on them? I'd like to start with you, James, because I believe you have some interesting insights.
Yeah. So I mean, this is a perfect kind of segue from kind of the exotic, more aggressive use of UDAAP, including abusive. Me and some colleagues, we filed an amicus brief in the Southern District of New York in a case brought by the CFPB and the New York AG jointly against an indirect auto company. And the reason why I want to call that out, other than my kind of personal involvement, so it's kind of top of my mind, is two of the claims are perfect examples of everything we've been talking about. They are aggressive, novel uses of UDAAP. And I'd say take it up further, because the conduct at issue is either expressly permitted by TILA or expressly not banned by TILA. And they don't like it. Again, they're outcome oriented. They have a paternalistic view. It's a practice in the marketplace that's been going on out in the open for decades. And instead of doing amending TILA, which is never going to happen, but public rulemaking on Reg Z, they just like concoct a UDAAP theory and then they litigate it. So it's enforcement by regulation by enforcement and litigation. So in that case, it's indirect auto, right? These are credit sales. And I think, as we all know, in the credit sale, point of sale finance, merchants, dealers take a discount from the finance company. Right? I mean, think about how credit cards work. And TILA expressly permits it, right? It's, but again, in this case, the CFPB and New York AG assert that it's an unfair practice. And I think the one other thing about this example that I would point out, similarly, Truth in Lending Act and Regulation Z only imposes ability to pay requirements for credit cards, conspicuously absent from other areas, right? Well, mortgage is a different area. I'm not a mortgage person, so I'll let Brian. But on unsecured, it's only for credit cards, and certainly not for auto or student loans, for that matter. But again, in this lawsuit, they fashion a UDAAP theory to say it is unfair to not assess ability to repay beforehand, even though it's conspicuously missing from the Truth in Lending Act and Regulation Z, right? They're very clear when they want you to do ability to repay in Truth in Lending and Reg Z, and when they're not. And in this case, you're not required to do it, but they want to impose that, make up that requirement by fashioning it as a UDAAP.
Wow. Brian?
James, I just have a couple of questions. So, with respect to ability to repay, do they provide any explanation as to how that would happen while you're sitting at the car dealership to get your car loan? And then second, my second question has to do, when you talk about the discount, right? That's almost the buy now, pay later model, right? Because it's no interest for 4 weeks. I buy $100 mascara from Sephora, and the buy now, pay later people pay Sephora $95, and I pay the $100, right? And so those are my two questions.
Yeah, I'll take them in reverse. I mean, the merchant discount, I don't know the answer to that. There's kind of no rhyme or reason why they object to it in this context, but not elsewhere. So I don't know. And then on the ability to repay, I mean, it's not in the complaint. Whether or not privately they discussed this is what you should be doing in a more detailed prescriptive manner, I don't know. But my point is it's not required. And even if they did have private conversations, it's kind of like you can't just unilaterally tell me how to do one, that I must do ability to repay, and tell me how to do it when you haven't gone through the proper rulemaking process like you did with credit cards ability to repay in Reg Z. So if you're going to do it fairly, openly, with comments, with input from all stakeholders. Don't just have 3 enforcement attorneys tell me how to do ability to repay.
I think that's actually a really good point. I mean, again, if you look at Reg Z, for example, the steps you have to go through to do the ability to repay analysis are complicated. You have to do it in a certain way and a certain process. And to just say, oh yeah, do an ability to pay analysis without saying what exactly that entails does make it a lot harder to actually turn that guidance into an actual compliance program or into policies and procedures.
Absolutely.
Actually, sort of just a little different than talking about another enforcement trend that I've noticed. The CFPB also seems to be taking a lot of interest in, I guess we could kind of call add-on products. These would be things like, programs where you sign up and you get charged a monthly fee for something. If you sign up for a credit card, if you get some sort of insurance or protection, that'll take care of the balance in case some issue comes up. They seem to have a lot of concern that all these add-on products are basically just a way of putting fees onto people without giving them much in return, or they have this concern that people are kind of being, again, according to CFPB, they're sort of being tricked into signing up for these things without realizing they're going to be getting, for example, a monthly payment or some sort of ongoing payment over time that, the CFPB, I guess, is concerned that, the person will forget that they signed up for it and every month they'll keep paying this charge without really using this product that they signed up for. So I think that's something actually they've started to show a lot of interest in, and they're trying to find some ways to either get people to pull back on them or to really strengthen the ways that these programs are disclosed and presented to consumers, and making sure consumers are reminded for them after they sign up.
Yeah, that's happened to me. I had a couple of subscriptions where it was like, I forgot I even subscribed to that, and going through a bank statement and was like, what is this?
Right.
And they've been taking money out of my bank account every month for a year. So it's sometimes, I think it can happen. Sometimes it can be confusing to the consumer. I don't know if it comes through, it needs to come through better in a disclosure, or how can we better educate the consumer? Because that to me, it is a consumer protection issue, but I think that it is an opportunity across the board with those types of disclosures. You know, if we're doing add-ons, there should be a disclosure, and maybe even that reminder that you have this, do you want to continue it, you know, periodically. I think it's great marketing. I think it builds trust with the consumer.
I think that's right. Though I think part of the issue is the CP is kind of coming at it with more of a hatchet than a scalpel.
Yeah.
You know, I have some banking clients, for example, some of these add-on products, they created them because customers were coming and say, well, I'm having a problem with X. Is there any way you can help me? And the bank will think about it and say, you know, if we create this extra product, it'll give you this extra layer of protection in case this particular issue arises. You know, a lot of these programs can be very helpful for consumers. So the idea that they could just be not knocked out in a broad stroke, kind of, in a way, it's anti-consumer. It takes away a consumer option.
So how do, and with you guys, I know you probably have a lot of clients, you definitely, Brian, in the mortgage space and James in the fintech space. How are you guiding your clients to help them to avoid these potential pitfalls? Because as you said, they're coming after them with a hatchet. So if they're coming after you with a hatchet, you know, maybe there's some safeguards that they could put into place to just make sure that they're protecting themselves. Brian, what are your...
Well, so part of it, we try to stress to our clients that compliance is an ongoing process. You don't do it once and then you're done. Right. You know, for example, you know, a lot of our clients, they have a policy and procedure about UDAAP compliance. And a lot of them, they look and they say, well, the statute hasn't changed. They haven't released a new formal regulation on UDAAP. Therefore, we don't need to update our policy. Everything's good. And our thought says, well, actually, you know, the statute might be the same. The regulations haven't been changed, but there's a lot of new guidance. There's consent orders. There's other things that are coming out that are kind of, again, either previewing what the CFP is expecting or showing these changed interpretations. So what you really need to do is, again, you know, sometimes it's once a year, once every other year, there might be an appropriate length of time. You really need to go back through these policies and procedures, look at when they were written, and then how things have changed over the last, you know, again, year, 2 years, to make sure you're really encompassing the major concerns that are out there. You know, again, a lot of our our clients, they're focused on their ads. They want to make sure their ads are not deceptive, which is really, again, extremely important. But, you know, making sure the ads are not deceptive is not the whole gamut of UDAAP protections.
Exactly.
So again, we're just trying to stress to them that it's an ongoing process, that you really have to keep track of what's changing and make sure you're keeping up with those changes. And in some case, you're being proactive to get ahead of where you think changes are going to be happening going forward.
Very fair point. I think James.
Yeah, really quick. And then, you know, I'd love to hear what Pia has to say, because she's kind of wearing that in-hat role. Just a couple of, I think, practical considerations, and consistent with the theme and what I've been saying. You're not going to find it in UDAAP, in precedent, in the elements. So this is kind of the overlay of what the regulator expectation is that isn't rooted necessarily in the statute. I think you have, you know, the product or service, you know, you have to be able to clearly convey the value to the consumer, right? You have to make that clear. What is the value proposition to the consumer? So that's kind of the disclosure communication part. But then here's the outcome part. You have to actually allow the consumer to reasonably unlock and get the value of the product or service. It's one thing to tout it, but if you put obstacles or make it difficult for them to actually access or use, the
Yeah.
value. That's where you're going to have an unfair and abusive problem. And then, you know, you have to Brian's point, it's not just the front end, you know, go through compliance before product launch. You have to actually track product usage and the outcomes, the data afterwards, to make sure that actual usage in the wild, you know, is sensible, it's reasonable, right? That the outcomes individually or in the aggregate are reasonable, they're fair to the consumer, you know, whatever that might be. I mean, he talked about add-on products. If an optional add-on product is you know, adopted or used 95% of the time, that's going to be a red flag for the CFPB. So then you know that you have to go back to the drawing board and say, is the process and the disclosures around the optional add-on, are they really good enough? Or are people going to assume that they're really not optional?
Right. No, thank you. And Pia.
I think those are fabulous points, as far as policy plan for review of policies and procedures. I always say you're better off not having a policy if you never read it and don't do it. So you definitely need to read it and make sure, you know, that it's trained on in the entire company. I think, James, the tracking is absolutely essential. And so I think you can convince the use of resources in the tracking from a business perspective as well, right? Well, of course, we got to track it. Like, is it worthwhile to even have it? All those kinds of things. And then you get into value propositions that could be conflicting. And so this is just a concrete example. So in the subprime space, sometimes credit insurance is offered. So on the one hand, right, these are subprime folks, they don't have a lot of savings. If something happens, this credit insurance will take care of that obligation. On the other hand, if you're dealing with folks who don't have a lot of money, shouldn't every dollar they have go to paying off the obligation as opposed to paying a premium for the credit insurance, right? And so, like, where does that come out? And so I think that that's part of the add-on product UDAAP, right? For some people, I think it's a glass half full, half empty. Like, some people would look at my two choices and be absolutely certain which is the right one. And right, and that doesn't help when you're working with a regulator, even though they might be as certain and not have a nuanced an ability to approach things in a nuanced way, but it's not black and white.
That's for sure. That's for sure. So we're gonna, for the sake of time, because we have just gotten into this conversation and I still have a whole bunch of questions. I want to talk a little bit about going into a little bit of the identifying and mitigating some UDAAP risks. So many of our clients are in the marketing compliance side of the world. There's also a lot of our clients that are utilizing our product for performance purposes. So we know UDAAP has been a hot topic for a lot of our clients. And so we recently put together a UDAAP report that did a deep dive into some of the most commonly flagged terms and phrases based on the thousands of marketing assets that we're ingesting for our clients and our platform. And this is on a daily basis. So some of our top finds highlighted in the report were around exaggerated claims, subjective language, no barrier to entry, and false sense of urgency. So there's so many layoffs in many spaces of the financial industry right now, as we all know. And I've seen some instances where marketing teams have been taking over the marketing compliance pieces from the now shrinking compliance teams. What advice would you give to companies that are trying to scale their businesses during these times, and especially those that are no longer allowing their compliance or no longer have a compliance team or a full compliance team that can handle some of those issues? Who would like to go first? I'll turn it to Brian.
Sure. Well, again, our advice to our clients is be very careful when you scale back your compliance department. It might seem like an easy way to save money in the short run, but a few years down the road, when you get a civil investigative demand from the CID or a DOJ subpoena, it might suddenly seem like you haven't actually saved a lot.
Compliance people.
Well, so one of sort of something interesting, you know, the CFPB isn't really concerned about how if the economy is up or down. They're not really concerned if your business is making a lot of money or not. You know, with some of the bank regulators like the FDIC or the OCC, they're actually very concerned about the stability and soundness of the bank. They really have a problem if a bank goes under.
Sure.
The CFPB has less of a problem if your auto lending business or your credit card company goes under, because that's not part of their mission. So from their perspective, the fact that you're in a tougher economy is just not something that they're really going to consider when deciding what's necessary to protect consumers.
Yeah.
And so kind of going to that, obviously, again, this is a hard time. A lot of companies are facing some volatility. And the best thing we can tell them is, you know, you really want to focus on putting some of that advanced investment into, like, again, your compliance management system, for example, because you know, once you get it set up, I don't want to say it's going to run itself, but the after the fact costs are going to go down significantly. Basically, it's just, you know, making sure you're integrating all these things into your businesses to make sure you're collecting information you need as it happens, as opposed to ending up in a situation where it's the end of the year and you suddenly have to collect, you know, 50 different types of documents from 10 different departments, and everybody's scrambling to do it at once, and also trying to do all their regular job duties. Yeah. So again, the best advice we can say is just, you know, again, focus on getting things set up front so that you can save money on the back end, and that way, if there are fluctuations in the market or difficulties, you're less faced with this concern about what needs to be cut.
Absolutely.
And from an in-house perspective, right, I think the reduction, you know, let's be practical. How can a company reduce some headcount for a handful of months, right? Like, not permanently. So what is your least risky advertising material going to be? Well, stuff that you've already used and you're not even changing a comma, right? And I'm not saying no risk, but that's going to be the least risky piece to use. Now, if you've decided to get rid of your compliance review, creating a brand new piece is not advised. Right? Stick with what you got, and then, you know, to keep your costs in line, maybe consider a fractional general counsel. You know, it's something that can work for you budget-wise. But I think that's part of it, is there are some practical things you can do to minimize the advertising risk if that's the situation you're in for a handful of months.
And I think there's still that competition, though, because now the market is getting a little bit more competitive. Everybody is trying to be seen and they're taking more risks. So it's like you're taking more risks, but less compliance. That's, yeah, it's kind of scary for folks. James, did you want to weigh in on that one?
Just a quick point. You know, if the objective, and I think it is for everybody, especially if you're earlier stage, is to scale. To me, scale means grow primarily by volume. And I think the way that you could balance that growth while managing risk is to reduce complexity, right? Yeah. When I hear companies want to do something so complicated, it's actually you're multiplying the risk, because the product itself is complicated, so that's embedded in the product and the processes around it, but then their execution risk is also magnified. So I mean, it's kind of like not pure legal advice, but I think the practical compliance business advice is, okay, I get it, you have to scale, your investors require it, you got milestones you got to meet. Can you kind of reduce some complexity so that you could scale without taking on undue risk?
Fair.
And there is the cardinal rule, right? You cannot cut your way to growth. It's impossible. And it's impossible for governments, municipalities, companies. You can write out some hard times, deal with cash flow issues, but if you really want to scale, it takes investment. And so I think that's something that people need to be reminded of.
Sure.
Is you're gonna throw out this number of people. I don't think they were sitting around doing nothing.
Right.
So it's going to impact your growth trajectory.
For sure. It's difficult times, that's for sure. Were you going to say something, Brian?
Yeah, just one other thought. I think this kind of goes on is part of it's the job of either the legal department, the compliance department, your outside counsel. It's helping your clients understand where the risks in their business are, because most of our clients, the people, again, for example, for a mortgage company, the person who started them, they were usually somebody who started out as a loan originator, someone who, again, met with customers, and explained to them the product, got them to agree to a loan, so that their background isn't necessarily going to be in terms of compliance or risk management.
Right.
So again, so the third parties, your outside counsel, your legal department, really, they have to educate sort of the business side people on what the company's areas of risks are, so they can make an educated decision about what can be cut with limited risk, or what can be expanded with limited risk, versus what are more high risk areas where, again, you're going to have to do things a little more slowly and a little more deliberately to make sure. It's just, again, making sure your clients or the business side people really understand all the aspects of their business, and not just, for example, the sales side.
Absolutely. So I know we always hear folks talk about the importance of building a sound compliance program that includes updated policies, your training, making sure it's timely, and everything is like going a million miles a minute right now. So one of the most things that important things that a business can do is to ensure that they're monitoring and that they're documenting. What are some areas where you would recommend our viewers place a little bit more attention during these times when they have smaller teams, but yet everything's on spreadsheets or in file folders or who knows where? What's some advice that you can give them?
Just again, one thing. There's a lot of software out there that makes it a lot easier these days to automate business functions or to track things automatically. I've seen this a lot, in particular with respect to training. If you're tracking, which staff members or which employees went to which training programs on an Excel spreadsheet, that's kind of the bare minimum. I mean, really, there's a lot of software these days that'll really make it easy. It'll automatically know when the person did their training. It'll send them notifications when they didn't, tell them to go get it. It'll tell your compliance officer, hey, employee X hasn't done training Y, so you really need to get on them now, because the 1 year deadline where they're supposed to have that training is coming up, or it might have passed, so you really need to make this happen. Again, it is a little bit more of an upfront investment, but the amount it saves you in terms of employees manually inputting things on spreadsheets, in terms of compliance risk, it really tends to pay off in the long run.
I agree.
And Brian, I think that's perfect. And the example with the spreadsheets and everything else, right? Resources aren't just dollars. It's people, it's time, it's all of those kinds of things. And so there are some great solutions.
I guess that leaves me last here. So I'm going to kind of turn away from resources, because I think you guys got that covered. I think I try to put myself in the shoes of the people I work with, right? So they're in-house counsel, maybe compliance, and they have to sometimes butt heads with business, right? And it's hard to educate business people about the UDAAP risk because it's so subjective, blah, 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 right? So I think one helpful tool for everybody, it's an exercise for everybody, and business people I think will understand this intuitively, is can we explain, defend, and feel comfortable about whatever it is that we're considering doing? If it were blasted in mass media, my grandmother, a judge, Washington Post or whatever, because if you kind of frame it as a legal issue, it might be a tougher education process if you're the in-house legal or compliance professional, but if you kind of phrase it that way, which I think more aligns with how the CFPB views it, because as we said, they don't feel bound by precedent. So that would be my suggestion, is kind of like all of this is kind of, it boils down to, do we feel comfortable explaining, defending this to the media, the mass public, a judge? Forget the technicalities of the law.
Absolutely. Protecting the brand is very important. That's one of the things we take very seriously with our clients, is making sure that, you know, our tenants are discover, monitor, and act for that reason, because you want to know what's out there so that you can be on top of it and take action before the regulators come after you. So I thank you guys so much for such a great discussion. As we're concluding, I want to go around the horn one more time to allow each of you to share some of your closing thoughts and maybe a takeaway for our attendees as it applies to UDAAP compliance and risk. And if you have anything that you'd like to share with them, that would be great. Let's start with Pia.
Thank you so much for the chance to participate. I feel like I have some great takeaways, and I think people should find folks like Brian and James and PerformLine, and perhaps exactly them, for the pulse on what's happening. And my big takeaway for a new way to articulate and think about it is the results-oriented aspect of the CFPB. And I think I've thought that before, but I think that way to articulate it is just fantastic and will also frame my thinking.
Thank you so much. James?
I guess this is a little bit of a looking ahead thing. Like a lot of people in my field, I'm carefully tracking, at this point, it's not really tracking, awaiting Supreme Court decision on the CFPB constitutional issues. But that's kind of obvious if you're a CFPB practitioner. I think related to that, there seems to be a broader challenge against administrative agency regulatory power. So I'm keeping careful track of that too. And I don't oversell that to say companies feel like they have carte blanche to do whatever they want, but it's just, these are sea change potentially developments that we should all keep an eye on.
For sure. And Brian?
Yeah, I guess sort of the thing I always go with is there's two phrases that really scare me. It's one, everybody else does it, or two, that's the way we've always done it. Whenever I hear some of those phrases from clients, that's kind of a code red moment, like,
Yes.
well, that's interesting you said that. Let's think about that, because you'll see these instances where said, you know, we realize we've always done it this way, but we actually aren't really 100% sure why we do it that way or how that makes it legal.
Yeah.
So again, it just goes back to this, that compliance is dynamic. It's always changing. Kind of going with what James said, you know, regulation can be cyclical. You could have a really laissez-faire administration that really is hands-off, and then you could have a new one come in and suddenly everything's back on the table, and you know, there's no grace period. We're going to heavy fines right away. So again, it's always staying up to date about what's happening and what you can do to get ahead.
Absolutely.
Or at least not to fall behind.
Exactly. There you go. And I would say that my takeaways based on James's statement is, you got to be able to explain it. You got to be able to defend it to your mom, your daddy, the regulators, and everybody else. So I will remember that one forever. Thank you so much. This was such a great discussion. I think that everyone is probably hopefully filling up the box with questions for you guys. And hopefully we'll have you guys come and visit us with us again for one of our future sessions.
Thank you so much for having us.
Thank you.